Hey everyone, welcome to This Explainer. Today, we're going to fundamentally shift how you look at your bank account. We're going to unpack exactly why investing absolutely beats just letting your savings sit in a bank, and how you can stop your money from just sitting there and instead force it to work for you. So, is your hard-earned money actually shrinking in the bank? You know, most of us are taught from a really young age that the absolute safest place for our cash is sitting quietly in a savings account. But here's the thing, leaving your money completely uninvested, it's basically a guarantee that its value is dropping every single day, month, and year.
And the culprit here? Good old inflation. It's this invisible force. Think about it like this. Remember just a year or two ago when you could grab a nice big packet of Kurkure for 10 rupees? Well, go to the store today and that 10 rupee packet is looking noticeably smaller, right? If you want the original big size, suddenly you're shelling out 30 or 40 bucks. That, right there, is inflation in action. It literally eats away at the aukat, the actual worth and purchasing power of your money every single year.
The math behind this wealth leak is honestly pretty startling. Let's look at the numbers. Inflation usually hovers around, say, 5 to 6% a year. But a standard bank savings account, that might only give you about 3%. So you are mathematically losing money just by doing nothing. But if you look at a basic investment, like a fixed deposit giving you around 7%, that acts as a shield, putting you just slightly ahead of inflation.
So today, we're going to map out exactly how to stop this leak. We'll cover bank savings versus investing, then dive into fixed deposits and PPF, look at mutual funds and compounding, touch on gold and cryptocurrency, and finally, lay out a clear, age-based investing plan so you can start executing immediately. All right, let's jump right into section 1, bank savings versus investing. The choice here is pretty stark, guys. Hoarding cash at home or even just leaving it in a basic checking account basically means you're volunteering to take a 5 to 6% loss in purchasing power every single year. It's a guaranteed loss. Investing, on the other hand, well, that's the only realistic way to multiply your hard-earned cash over time. So investing isn't really an option anymore. It's an absolute necessity. Section 2, fixed deposits and PPF. These are what we call your foundational inflation. Let's compare a couple of the most reliable ways to protect your cash. With a fixed deposit, you can expect an average yearly return of around 7 to 8%. So that keeps you just above that 6% inflation rate we talked about. But look at the PPF, the public provident fund. It offers a solid 7.1%. And here's the best part, the profits you make are entirely tax-free. Now the trade-off is the PPF is more of a long-term game. It has a 15-year lock-in period, though you can make partial withdrawals later on. FDs are definitely critical, but honestly, those are fantastic, safe tools to make sure your money is free. You know, a lot of people actually get scared off of FDs because, well, they have to pay tax on their bonds. But paying tax simply means you successfully make money. You're in the green, so don't let the fear of normal tax prevent you from going. Moving on to section 3, mutual funds and compounding. Now your cash is shielded, it's time to build some serious wealth. Okay, let's really dive into this growth engine. A mutual fund is essentially a pool of money managed by seasoned financial professionals who do the heavy lifting and invest it into the market for you. Historically, an average index fund, Nifty 50, has returned somewhere between 12 and 15% annually. And get this, some top funds have even hit 25 to 30% in recent years. The best part is, you don't need a huge lump sum to get started. You can just use an SIP, a systematic investment plan, which automatically deducts a set amount from your account every month. It's hassle-free, flexible, and it unlocks the absolute superpower of finance, compounding interest. Just consider the staggering number for a second. 6 crore rupees. Let that sink in. Where does a number like that even come from? Well, if you invest just 5,000 rupees a month into a mutual fund that averages 12% return for 40 years, whopping 50% of the portfolio is fueling that growth engine of mutual funds. Another 20% is in high-reward crypto, and the remaining 30%? That's your safety net, split evenly across FDs, PPF, and gold. Now, let's see how it shifts for someone mid-career, ages 35 to 50, as responsibilities like a family and